Yo, what's good, YouTube? This is Easy Trades, man. So what is liquidity? How do you know to draw on liquidity? How do you know where price is going to go next? Okay, so what is the actual definition of liquidity? Liquidity is how quick something can be bought or sold. If I have $100 pair of Air Force Ones and I know that they're a rarity right now, I know that I can sell them for $100 or better at the snap of my fingers. There's going to be plenty of willing buyers out there. However, in Forex, we have something called internal liquidity. We have something called external liquidity. There's two types. Now, it's actually internal range liquidity and external range liquidity. Now, when we speak internal and external range, we're talking in absolutes, the outside of the range and the inside of the range. So the first thing that you need to be sure of is what is the range. So I'm going to take you into my charts here real quick. This is not going to be a long video. The range, how you know the range, you pick the low point and you pick the high point. This here, everything in between, the low and the high is our range, okay? Now, if we look at this, we pick the high point and we pick the low point. In here is our range. So since we understand the range, we can go ahead and go in there and mark up our external range liquidity. Now we can go even further. This is external range liquidity as well. This is, I would say this is external ranges liquidity as well. Why? Because this is a swing low, this is a swing high. It's simple. Now, internal range liquidity, we'll go into a little bit more depth about it. Internal range liquidity can be inefficiencies. It can be short-term highs, short-term lows. When you drop into a lower time frame, you're automatically going to see internal range liquidity. We're on a 1 hour chart. If we drop into a 5 minute, a 15 minute, 3 minute, we're going to see liquidity highs and lows in this range of price right here. So let's go ahead and let's do that. However, I do want to note right before we do that an inefficiency can be a draw on liquidity as well. Why? Because it's inefficient price delivery. Now, I want to make something clear to you. This market is not here so that you can make money from it. This market is here to extract money from you. So right here, we see an influx of sellers into the market. There's more sellers than buyers. Either that or the market was just in a sell program. Then buyers and sellers doesn't matter. If you're an ICT student, okay, we're going to go ahead and drop to the 15 minute, okay? In the 15 minute, we see that this is internal range liquidity. Why? This is a high created inside of our external range liquidity. Does that make sense? This right here is a inefficiency in our range of liquidity. So this can be a draw on liquidity. Now let's drop into a lower time frame. This swing high is internal range liquidity. It's actually fairly simple when you can do a top down. Okay, this is the range that I'm working with while I'm trading in this session. I'm a scalper. I trade it from 9:30 to maybe 11:30 max. So I don't need a large range of liquidity. I typically just mark up the most obvious liquidity, okay? That includes inefficiencies. This is a obvious inefficiency. This is a obvious low. These were obvious lows. Okay, another way that you can find a draw on liquidity is looking for relatively equal highs or lows. Right here, we can see relative equal lows. We understand that there's a lot of liquidity resting underneath of these lows, and price, like I said, is out to hurt you. It wants to take the bag from you. Okay, so that low is going to get taken out at some point. If you set your stop resting above relative equal highs, you're most likely going to lose. It's that simple. Price is going to seek out those relative equal highs or lows simply for the fact some people trade support and resistance. They'll see that as support. Whole time, price is going to fake them out, take their money out the market, and then make the move. Because I want you to understand, if you took a buy right here, right? Let's say you took a buy right in here and you set your stop at this relative equal low. When price stops you out, you're going to have to sell your buy so that price can continue in its direction. Then it'll come up, rebalance, and then go about its way. But you have to understand, you have to sell. If you're taking a sell, putting your stop above relative equal highs, when price stops you out, you have to buy. I hope you understand what I'm saying. Okay, boom. I want to move to another example. We're going to go real quick, and then I'm going to give you guys a tip on, for my scalpers, how to understand where price is going in your session, whether you're going to London, whether you're trading in London session, whether you're trading in New York session. Okay, I told you this is going to be a quick video. Okay, cool. So this is actually interesting. So here we have more relative equal lows. I'm going to go ahead and I'm going to mark that up. Now, like I said, when I'm trading, I'm looking to get in and out of the market within one of these 1 hour candles. But let's say you're a swing trader. This right here would be something that you would target if you were going to get in when price comes back up here, or this would be something that you would target if you're a swing trader as well. You see how price this is all relatively equal. So you know what, I'm going to delete this. Maybe this is something that you would target, this low down here. But not only that, if you're swinging, you're going to be in for a while. So this is going to be a part of your range as well. Now for my scalpers, this is my range right here. This is my range. This is my external liquidity. This is my external liquidity. This is my internal liquidity. Now I didn't have to jump into a lower time frame to do that, simply because these lows are pretty much equal, and we may go ahead and we may take out this low here. Now another thing, like I said, if price is inefficiently delivered, it has to efficiently deliver for the market to be perfectly liquid. If I have $100 pair of sneakers and I have many buyers out there that are willing to pay $100 for these sneakers, that is a perfectly liquid market. There's supply and there's demand for sure. Okay, but right here we see absolutely no price action. This is an imbalance. This is a huge inefficiency. This is called a volume imbalance. Supply and demand is volume. Liquidity is volume. Okay, now this is an imbalance in volume. So this must be balanced. Now I want you to also peep game right here. It looks like price came and rebalanced it at the equilibrium, perfectly at the equilibrium. Now, if you guys want a video on equilibrium and optimal trade entries and how to use your fib, let me know in the comments. We're going to drop to a 15-minute chart. We're going to get some more examples of some internal liquidity. Okay, so on a lower time frame, we don't have that large gap, that large inefficiency, volume imbalance, I'm sorry. But we do have this right here, this inefficiency as well. This is a SIBI. If you guys want a video on SIBIs, holla at me. Holla at your boy. Price is going to take liquidity and then move towards the imbalance, because this draw on liquidity right here is way closer. It's way closer. It's way easier to stop out these buyers, take this money right here. Especially we have this imbalance right here. There's a lot of money right here in this market. There's a lot of money where the market is sitting at. So let's just go ahead and let it rock out. Price took liquidity, then moved towards the inefficiency. Okay, it's actually fairly simple. If you don't understand this, go into your charts and backtest. Backtest the old data. All the answers are there. Backtest it until you can see. You'll know when you can see. There's just a feeling when your eye can catch things like this. Do it until you can see. It may take hours, it may take days, it may take a year, but it will change the game for you. This is a key component of trading. I'm not going to go into this any more deeply. This is the basics of liquidity, but I do want to give you guys a key. If you guys are scalping, if you guys are trading New York session, London session, you're looking to get in and out of the market within a 1 hour candle. Here's a key. You want to look at old highs and lows, old daily highs and lows to be specific, old Killzone highs and lows to be specific. These boxes that you see right here, this just marked up the London session low for me. Now I want you to pay attention. I have no idea what we're about to see to the left of this chart, but I guarantee you this low just took out liquidity from either a London session or a New York session. Okay, so we're going to go right. This low right here that it took out was created during New York session. This inefficiency created here, which is a draw on liquidity as well, like I said, was created during New York PM session. If you want to understand liquidity and you're a scalper, look for price to target the lows and the highs of old kill zones. It works pretty much every time. If you set these kill zone lows or highs as your take profit after you understand the draw on liquidity, I promise you it's going to be a game changer. If you cannot see that in your charts, go back test it, man. Because once you're able to see, you're not going to be able to unsee it. Nobody can take it away from you. I want to show you guys one more example. We're going to go right here. These highs and lows are typically taken out in Killzones. London Killzone low or London Killzone high is typically taken out during New York session. New York session lows or highs is typically taken out towards another New York session or a London session. They may not take it out within the same day, but price is always going to target these. You know, it's an interesting question if you were to ask why. That's for another video. So check this out. New York low, London high. Price stabbed above it. This is a New York high. London high stabbed above it. This is a relatively equal low created by New York PM session and New York lunch. Price stabbed below it, returned to imbalance this internal range liquidity, and then continued about its move. So that's about all I got for this video. I got some more sauce, but I'll save it for another video, a more in-depth video. This was a requested video, so yeah, man. So the next video I might go a little bit more into depth into what a fair value gap actually is, because a lot of people use them, a lot of people mark them up. They don't know what they actually are. They don't know the definition of a fair value gap, man. So I'm gonna get with y'all on the next video. Y'all stay great, man. Peace.